Welcome to the latest episode of Quest for Twice. In the last episode, I discussed my growth portfolio and my strategy to invest in growth companies. So they include diversification, looking at the valuation, as well as understanding the moat around the business. So today I'm going to discuss the valuation component. So how to evaluate a growth company? In my opinion, discounted cash flow model is not something that can be relied upon. Why? Because for growth companies, the growth rates are usually higher than the discount rate. So most of the NPV comes from future. As I discussed last time, the future growth rate and the corresponding cash flow from operations are very uncertain and hard to predict. As a result, even if I run a discounted cash flow model, I cannot rely on the NPV coming out of the model to compare with the current market cap. So my approach is to ask, how fast can the company grow out of its current high valuation, assuming its current valuation is too high? So that's really an attempt to understand the downside. Let's look at the Boston Beer Company as an example. So its current price over gross profit stands around 6, with a 10-year compounded annual growth rate of 12%. So let's use Anheuser-Busch as a benchmark. So Anheuser-Busch has a price over gross profit at 4, with actually slightly negative compounded annual growth rate. According to Morningstar, the Anheuser-Busch is actually undervalued. But let's use the Anheuser-Busch's price over gross profit of 4 as my target. Then, with the 12% of growth rate, it will take SAM 4.5 years for its current evaluation to reach 4 if its stock price is stagnant. So that gives me a understanding of the downside. So if my investment is just sitting there doing nothing, then 4.5 years later, it'll be at a very appealing valuation level with a 12% growth rate, then the price will have to move up. So that's going to be the metric I use to understand the valuation of a growth company. So I introduce the concept of duration to reach parity. For simplicity, I'm going to assume the target valuation is 1. So that's a parity between the price and my valuation metric, for example, gross profit. So the duration to parity depends on the current valuation as well as the growth rate, so which makes perfect sense. The higher the current valuation is, the longer it will take to reach parity. However, the growth rate is much more important. In this graph, I plotted the duration to parity against the current price to gross profit ratio for 4 different growth rates. So the dashed line is a growth rate of 15%. So it's fairly steep and can take a long time, more than 20 years to reach parity if the current valuation level is high. However, with the faster growth, for example, 25%, 35%, or 45%, it takes a much less duration to reach parity. And also, with a high growth rate, for example, 45%, the curve becomes fairly flat. At that rate, if a company doubles its valuation level, for example, from 15 to 30, it only takes 2 more years for the duration to parity. I also want to note that with a low growth rate, it's invalid to use parity as the target. We have to be more precise. For example, for Boston Beer, I used the price over gross profit of 4 as the target because that's benchmarked against Anheuser-Busch. So for a low growth rate, it's important to define a good ending point. However, for higher growth rates, it's not so important to define the ending point. So a parity or a 1-to-1 ratio is good enough as a screening tool. So let me apply this concept to the ultimate growth companies, the FAANG, Facebook, Apple, Amazon, Netflix, and Google. So those companies have been growing for a long time. So low duration to parity provides a downside protection, but long durations may be justified for companies with a long growth horizon like the FAANG stocks. In the past, it doesn't really matter what the durations were for those companies, because they just kept on growing. So even if the durations were high in the past, they were still justified because of the persistent growth of those companies. Now, let's take a look at each company. Facebook has a price to gross earning ratio about 12, with a sales CAGR of 28%. Duration to parity is about 10 years. It should be noted that Facebook benefited from a COVID lockdown with a lot of small businesses shifted their marketing expense from physical world to online world. So the growth rate may be a little higher than usual. For Apple, the price over gross earning ratio is 17, with a growth rate of 9%. Its duration is over 33 years. It should also be noted that the 5G adoption really started with the iPhone 12 introduced about 1 year ago. So the growth rate has not fully affected the impact of 5G adoption and its a blockbuster sales of iPhone 12. So one can argue that its growth rate should be higher than 9%. For Amazon, its price over gross earning is about 15, with a 29% growth rate and duration about 11 years. Similar as Facebook, Amazon benefited from a COVID lockdown, and its 29% growth rate may not be sustainable. Netflix, its price over gross earning is 22, with a growth rate of 29%. Duration is about 12.3. It's also a COVID lockdown beneficiary. And for Google, the price over gross earning is 15, with a growth rate of 17%, and the duration to parity is about 18 years. Although a lot of advertisements were shifted online, but a lot of Google's customers were in the travel industry, and they were severely affected by COVID lockdown. So the growth rate of 17% may be sustainable or may become better down the road. With those caveats considered, I still draw the conclusion that Facebook and Amazon have less downside than Apple stock. Because for Apple to justify the high valuation level, it has to grow faster than the past. Even with 5G, it may get a bump in 2021. But how sustainable is that? And that's really questionable. On the other hand, Amazon has been growing its advertisement business, AWS business, as well as subscription business, with very little difference before and after COVID. So even if the 29% growth rate moderates, it should still be able to grow at a fairly fast pace. And with the low duration, relatively speaking, then I consider that as a much safer investment than Apple. For Netflix and Google, I see them stay in the middle. Maybe not as safe as Facebook and Amazon, but definitely not as risky as Apple. As I mentioned earlier, the duration to parity is very sensitive to the growth rate. And that's the biggest challenge to apply this methodology, is to use the past growth rate to calculate the duration to parity in the future. So as we all have heard, past performance is not a guarantee for future performance. So there is an inherent weakness of using this approach. However, I do believe that it gives me a useful metric to understand the downside. So even if Facebook and Amazon slows down, if the slowdown is not too drastic, then with the already reasonable valuation level, the downside will be limited. So this is my take on the valuation of growth companies. Until next time, happy investing.